It's that time again. If you're a real estate agent and you're looking to finally build a business that creates consistent cash flow, but you're concerned about all the market disruptions, relax. You found your safe haven to learn the secret to success. List you last. Welcome to this week's podcast. Hey, welcome everybody. Bob Mangold, the listing coach, here with episode 10 of the If You List Your Last podcast. As always, thanks to all of you for listening, downloading, and sharing this podcast. So here's a quick tip for the week. Focus on your activities because you are in 100% complete control of those. For example, you're in control of talking to 10 potential sellers and or referral partners every day. The question is, are you focusing on the results or are you focusing on the activity? Because you need to remember it's the activity that's going to yield you the results. Remember, if you're doing the activity and you're not converting at the rate you wanted, we know then where to coach you up and work on your conversion skills. Make sense? Listen, I guarantee if you're talking to 10 potential sellers every day, your cash flow is going to explode. Now, last week, I shared the profit potential for homeowners that are selling their home and giving up their 3% mortgage. I also had a really quick discussion on a loan where the effective interest rate can be 2% or less. Now, after receiving a ton of questions from my own group, I decided it was probably a good idea to do an overview of how that loan works on this podcast. So that's today's topic. So as always, make sure you join our Facebook Real Estate Asset Advisor group to share your thoughts or your comments, or maybe you got questions on any of the discussions that I have on the podcast. And I encourage you to join our bi-weekly Elevate Business Briefing calls every other Wednesday at 1 p.m. Eastern Time. Now, you can register for those at www.com. That's plural on the briefings. And finally, go ahead and download my book. But most importantly, folks, read the book. If you want to know the systems and strategies that it takes to build a listing-focused business, it's all laid out in the book for you. So just visit over at www.com. So let's get started. So let's get into this week's mortgage market update because it was a steady week for mortgage-backed securities. If you have a 750 credit score or above, today's rate on a conventional loan is actually only 6 3/8. With a 700 credit score, the rate's 6.49, and a 680 credit score, you can get a rate of 6 5/8. And with a 620 credit score, your rate would be 7.49. Now, another option would be an FHA loan where the rate would be 5.49% with a 5% down payment. But remember, there's an upfront mortgage funding fee and a monthly MI on that loan. But it illustrates how important it is to be working with a certified mortgage asset advisor who can examine all the options for our clients. Now, I wanted to share that with you today using the FICO scores to highlight how important a person's credit score relates to the rate that they receive. Most importantly, it will have a significant impact on their monthly payment and how much home a buyer can qualify for. For news this coming week, the Consumer Price Index will be released, and that'll definitely have an impact on rates. Currently, mortgage-backed securities are still trading in the same range that we discussed last week, but what I can tell you, this week's CPI probably is going to provide direction for interest rates. The only problem is, I don't know whether it's going to be up or down, and it could still stay in that range, right? But as always, we'll keep you updated on that in our Facebook group. So make sure you go over there to Real Estate Asset Advisors, join that, and I share those kind of things as the week goes through. So now let's talk about last week's topic, and I'm going to switch over and share the screen so that I can give you some slides and walk you through the loan that we talked about last week, because I think it'll open up a lot of listings for you. So give me a minute and I'm going to switch over. All right, let's start here. Understand 30-year mortgages have been in place since 1939. The question is, why were they created? And most importantly, who benefits the most from them? I always tell you, follow the money. So here's what I would tell you. This is where all the money ends up at. It's Fannie Mae and Freddie Mac. And so we always hear people tell me that, hey, I don't want to look at any other mortgage options. I would never consider an adjustable rate loan, any of those kinds of things. And the reason for that, folks, is that they simply don't understand the math of it all. So I'm going to share a little bit of that with you today. So I always tell you to follow the money. So what I've got up on the screen is a $380,000 loan, 30-year term, 7% interest rate. Here's what that looks like. It's a $2,528 a month payment. The total interest paid on this loan is $530,134. That means the total cost of this loan is $910,134. So let me make sure you understand that correctly. You borrowed $380,000. You paid a total of $530,134 plus the original $380 back. The total cost of that home was $910,134. The problem is everybody focuses on the interest rate. They go, well, what? I want to get a 6.5. Give me a better rate. They never look at the interest paid. The reality of it is, folks, the real rate on that loan is 104. People are worried about 0.25%, 1/8%, whatever it is, and they're not focusing on the real number, which is the $530,000, which is 140% of what they borrowed. So suddenly 7% seems pretty cheap, right? So the question is, who does that really benefit? And the answer is it's Fannie and Freddie, which is owned by the government, which means it's the government. Now, bear in mind, folks, it takes 21 years and 9 months to pay this loan down to 50%. So I'm making payments for 21 years and 9 months only to get the balance down to a little bit less than half of what I borrowed. That doesn't seem to make sense, does it? See, my goal for people is to help them stop letting that happen to them and change their financial future. So there's got to be a better way. And there is, but it's not a 30-year fixed. So when I say it's a better option, if you mean a way for the borrower to control the interest dollars they pay, then hell yeah, I've got a better option, no question. What does that look like? See, it's a mortgage that never has to be refinanced again, can be paid off in as little as 3 to 5 years, dramatically increases their cash flow. They have access to their equity, 24/7 access to their equity. Don't have to do another loan. This is the last loan that they'll ever do, folks. And it could have an effective interest rate as low as 1.8%. Now, what does that mean? What does that look like? Because listen, I get it. It sounds too good to be true, but they do have to qualify. It is not available to just anybody. This is a little bit more sophisticated loan. It's meant for people that manage their money better. But for those that do, it's a big deal. And remember, folks, over the last couple of years, let's say one of your clients bought a house in 2020, like I shared last week, they now have plenty of equity. Even if they only put 3% down, they have 20% equity now, and they could qualify for that. What is it, right? It's not a loan for everybody. It's just not. The qualification guidelines are fairly simple. They need a 700 FICO score. There is absolutely no waiver on that. If it's 699, it doesn't matter. They don't qualify. They need either 20% down payment or 20% equity in the house if it's a refi. They have to have a 41% debt ratio, and they need to have 10% of the loan amount that they're going to borrow in reserve. So let's just use that $380,000 loan as an example. They have to have $38,000 in cash somewhere. Now, it could be an investment account, a 401k, a pension plan, any of those things. They just have to have it. Really what it's doing, folks, is it's demonstrating that these people know how to handle and save money. And they really do need to have excess cash flow each month. That's how it works best. Well, what does that mean? If they make, let's say, $10,000 a month and they spend $99.99 of it, even though they may still match these other things, it still may not be a great loan for them. The good news is where people don't have the cash flow, I actually have a 21-step process that I can walk people through that on average, I can pick up an extra $1,100 a month that people are spending that they don't even know is leaving their house. So the excess cash flow we can help with, but those are the quality guidelines. Now, it's available for primary residents, except in Texas. Texas has some crazy home equity rules. You can borrow it for a second home, or you can do it on an investment property. Now, on an investment property, it's a 70% loan to value. They need a 720 FICO score, and it's capped at $1 million. So there's some guideline things in there that I wanted you to know. Remember, I said this isn't for everybody, but I want you to understand the impact for it. Now, if they don't qualify for that, we still have an option that we can help people get the house paid down quicker, somewhere call it 10 years or less. But the reality of it is our goal when we meet with people, let's say they have a 640 credit score, they put 5% down. Our goal is to help them accelerate that mortgage acceleration over the next, call it 2 years. They're going to pick up equity and we can work on their credit score to get them to this point. But even if they never got to that, we have a system, the Equity Max system, that'll pay that down for them in a far more accelerated manner than they could on their own. So if you've got questions on that, just reach out, right? Now, here are the details. It's the borrower's mortgage. It's their savings account. It's their checking account. It's their debit or credit card account. And it's their online banking. It's the single Equity Max financial tool. It serves all purposes. And as I go through this, you'll understand why. But I want you to understand, normally we think of, we have a checking account, a savings account, debit cards, credit cards, things like that. This serves as everything, okay? Now, what this loan is, it's actually a first position home equity line of credit, or HELOC, but it has massive benefits for the borrower. So let's walk through how this works, right? I want you to understand it. And I'm going to make some assumptions here. So let's use some assumptions. And let's say the starting loan amount is $200,000. Their biweekly income is $10,000. They have a car payment of $700. They've got credit cards of $300. They've got student loans of $3,000. And it costs them about $5,000 to run their household. So they make $10,000 a month. They've got expenses of $7,000. And that leaves them, if you add the other numbers up, leaves them a little bit of fun money too. Go out to dinner, date night, some things like that. So they have 10 that comes in. They have 7 that goes out. Okay. You with me so far? Again, all assumptions. Everybody's scenario is going to be different. Okay. But we've got to start somewhere. So here's what this looks like. The interest is actually calculated on this differently. It is not a amortized loan. So it's calculated nightly and it totals at the end of the month. And here's what that looks like. The interest calculation is pretty simple. Whatever the nightly principal balance is, times the interest rate, divided by 365 days equals daily interest. This is a big deal. This is not amortized monthly interest. This is daily interest. Okay. So work with me. Let me give you some examples. $200,000 balance at 9%. Remember, it's a HELOC. And as I record this, interest rates are right around that for a HELOC. They're a little bit lower, but humor me. It doesn't matter if it's 9% or 10%, folks. It's still so massively beneficial. It almost doesn't matter. So a 9% rate divided by 365 days, meaning there would be $49.31 accrued in interest today. But they don't add that interest in until the 22nd of the following month. So what I'm going to do is I want you to understand this would be $49.31 today in interest, right? So understand the monthly interest payments are not due until the 21st of the following month. What that means, folks, is it keeps your balance lower for an additional 20 days. And then instead of making a monthly payment the way that you think of making a payment, the interest is simply added to your balance every month. I don't want to tell you don't have a mortgage payment because you are accruing interest. It simply gets allocated to the balance, but you are not writing a check for that every month. It's added to the balance. And you have an extra 21 days before it gets added to the balance. And I'm going to show you how that impacts you, right? So I'm going to go slow and I'm going to take it step by step. And if you're listening to this on the podcast, you might want to jump over to the video and watch it. That's why I'm sharing slides with you on here, okay? So let's say we've got a beginning loan balance of $200,000. Their first paycheck gets deposited into their account. Their first paycheck is $5,000. So on the first of the month, $5,000 deposit goes in. The loan balance is now $195,000. Now, this is a professional tip, and this is what we teach all of our clients. Arrange to have all of their bills due towards the end of the month. The longer we can keep that balance low, the less interest it accrues. So you can call each vendor, your utilities and your credit card companies, and you can change the payment dates on all of them. But you might, that first month, you might accrue a couple of extra days in there, so it might be a little higher than normal. But once you balance them to be paid at the end of the month, you'll see how it impacts you, okay? So let's do the interest calculation on that. It's now $195,000 today. 9% interest divided by 365 days. It's $48.08 that day for interest. That's $1.23 less than the prior day. Okay, you with me so far? So we're lower interest because we have a lower balance. Now, that's $48.08 instead of $49.13, I believe it was. So now we got a previous loan balance of $195,000, but your second paycheck is deposited, right? So your second $5,000 is deposited. And remember, we're going to move all your bills to the end of the month. So you haven't paid out anything yet. Your new loan balance is now $190,000. So let's do the math on that. 190,000, 9% divided by 365 is now $46.85 in interest due that day. It's $2.46 less than the prior day. So you still with me? See how those deposits are actually reducing the loan balance? But you do have bills to pay, right? So we got to do that. So now our previous loan balance is $190,000. And let's just say that all the bills got paid from that account this week. It's just easier for you to understand. So now all $7,000 leaves my account. My new loan balance is now $197,000. But my bills are paid. Okay? So we just had everything smushed to the end of the month, paid them all out. We're back to the loan balance now. Now it's $197,000. Interest rate divided by daily balance. Notice how it's $48.57. It's $1.72 higher than the previous days because my loan balance went up. See, it's going to fluctuate based on deposits and payments. So now we've done 1 month of this, right? But remember, that interest is not added to your balance until the 21st of the following month. So let's say I started this on January. I'm now sitting here on February 1st. My loan balance is $197, but I'm not adding the interest for the month of January until the 21st. Let's see what that does. So I'm at $197,000 is where I'm at in my loan balance, $48.57 a month. Let's go to the next step now. I'm at $197. I have the first paycheck of the month come in. I'm now down to $192. Remember, all the bills paid at the end. My interest now is at $47.34 a day, $1.23 less than the previous day. Remember, I said the interest is not added to your account until the 21st, which means my second biweekly paycheck comes in, and now my balance is down to $187,000. Remember, we got all of our money leaving the account at the end of the month. So right now I'm sitting here with a $187,000 loan balance. So look at the interest, $46.10 today. It's $1.24 less than the previous day. And we have a $187,000 balance. But we've got to make the accounting. The 21st of the month comes along, and the average interest on that was $1,440. It's added to the balance. You didn't write a check for a mortgage payment. The interest is simply added to the balance. I know it's a lot to comprehend. That's why I did the slides this way, which means your new loan balance is $188,440. Okay. So again, we haven't paid the bills yet. So let's take a look at the monthly bills being paid. I now just paid the bills of $7,000. My new loan balance after 60 days is $195,440, and everything's paid. Folks, in just 2 months, the balance went from $200,000 to $195,440, and they actually have instant access to the $4560 in equity. So let's say that, I don't know, they needed a brake job on the car. Instead of borrowing money on a credit card at 25 or 30% that's non-deductible, they could simply take and pay for it from their Equity Max loan. Make sense? So they have access to the equity, and their balance is $195,440. So I put a little chart down at the bottom. It would actually take you on a 30-year fixed amortized loan, it would take you 26 months to get paid down to the same balance within $30. 2 years of payments or 2 months. Now, I wanted to break it down step by step like that, folks, because you need to see how that happens. It takes a little bit to wrap your arms around and wrap your head around. So you might want to listen to this a couple times and go from there. But at the end of the day, I'm able to take an access or reduce my equity, my balance, and increase my equity, 5 times faster, 2 months, 10 times faster, folks, actually about 12 times faster. So at the end of the day, I'm able to take and pay this off. Now, imagine if we kept taking that out month after month. You see, the more disposable income people have, the faster this gets paid down. The money just sits in this account, reducing your loan balance, which reduces the interest that you pay. Now, a couple important things to remember. If you're getting paid biweekly every 6 months, there's an extra pay period, which lowers the balance by another $5,000. So twice a year, it's lowering the balance by another $10,000. What if somebody received a bonus or a tax refund? They get a pay raise. They have income from a side business, a second job, whatever, a side hustle. What if we actually worked on eliminating revolving debt? Remember the conversation we had last week? We eliminated their credit card payments, and I think we did credit card, student loan, and car payments. Well, all that additional income could be put towards paying this down faster. The reality of it is, last week's call, I wanted to be as conservative as humanly possible on giving you those numbers. So I didn't even factor in this kind of a loan, because you could see if we did this, imagine they bought a higher priced home, which increased their equity by $647,000. But now imagine if we got this paid off in 5 years. Again, how fast they get it paid off will depend on how much additional cash flow they have every month. And so our job is to try and help them eliminate as much revolving debt as possible. And remember, folks, I don't like, and I will never advertise this saying, hey, there is a no mortgage payment. There's no monthly payment on this loan. But in reality, you are not writing a check for this mortgage. The interest is simply being added to the balance. So the reality of it is, if you're used to paying, let's just say, a $2,000 a month mortgage payment, that's not coming out of your cash flow anymore. That sits in this account. That's an even bigger benefit. So all those things together help amortize this or help pay this off, and you're only paying simple interest on a daily basis. The lower you can keep that balance, the less interest accrues, and your deposits have more and more impact on the balance of the loan. Let's take this out a little farther. Let's call it 5 years, 7 years, doesn't matter what the number would be. The house is now paid off. What happens to the loan? The answer is nothing. It costs them $60 a year to leave it in place. And so let's say that they come across another house that they want to buy, and they don't want to go get another loan for that because, well, investor rate loans are more expensive. They have a $380,000 line of credit. They can write a check for $380 and pay cash for it if they want, and not have to go get another loan. And now guess what? Simply take the rental income from that property and apply it to the payment every month, to their cash flow every month, to now pay that house off even faster. Because, well, they don't have a mortgage payment on the investment property because they paid cash, right? So all the cash that would come in, call it $3,000 a month in rent, would go towards paying it off. Let's say that they want to, 5 years from now, they want to build another house, and they normally would have to go get a construction loan. With this loan, they could simply take the money out of this existing loan, this existing home equity line of credit, and use it to build the house. And then when they build the house, assuming that they're going to sell this house, they sell this house, and the other one is paid off. So there's all this flexibility in this loan, right? Remember I said, you can leave it in place. It costs you $60 a year. It never has to be refinanced. It is an adjustable rate loan. Make no mistake about it. That always freaks people out. And it's a HELOC, so the interest rate is higher. But at the end of the day, what people forget, folks, is if I was recording this in October of 2022, a line of credit interest rate was 10.5. Now it's under 9. But I didn't have to refinance to get the interest rate to come down. And the interest rate on a line of credit will always be more expensive than a conventional loan, in theory. But here's the reality of it is, folks, if I pay it off in, let's call it 5 years, and I'm making these numbers up now, but instead of paying $530,000 in interest, I paid $150,000 in interest. That's $380,000 that these people saved that they would have paid to the bank using a conventional loan. Now they have complete flexibility. The house is paid off. And if they want to use that money, they can use it for whatever they want. They want to take a trip around the world. Cool, go take a trip around the world. It doesn't matter. So what would happen if you were having conversations like that? Because hopefully you can see the impact that would have on people and what that could do for them in terms of being able to take and finance a house and build personal net worth. So let's say the house is paid off in 5 years. And let's just say they got $7,000 that they had leaving their house. What if for the next 25 years, they put that $7,000 a month away, call it 5%. I didn't do the math for you, but I promise it's in the many millions of dollars. And we did that with the same amount of money that any other realtor and lender is going to have them spend. Now, we have to explain this to them, and they're going to have natural reaction to, oh my gosh, I don't want a home equity line of credit. Oh my gosh, I don't want a revolving balance, or I don't want an adjustable rate loan. We just have to teach them how this really works so that they understand they're putting the financial power in their hands instead of the banks. So there's an education process, no question. That's why I thought it would be beneficial that I explain how this loan works. I don't expect you to be a miracle worker with it and have it all memorized. The easiest thing I can recommend, if you have somebody that wants to look at doing one of these, then just go to brainstormwithbob.com, schedule a call with me, and I'm happy to jump on the phone and explain this to your clients. And you could always go to www.profitfromyourmortgage.com. You could watch this whole, it's a little bit more detailed presentation than this, but I'm using the slides from that. And simply start to get good at understanding how it works so that you can have the conversation. Because imagine if we say we did a little short, right? We took out our cell phone and we record a video. Hey, Bob Mangold here with eXp Realty. Hey, you know what? A lot of people are telling me, listen, I would sell my house if I didn't have to get rid of my 3% mortgage. So you know what? I actually did the math on this. And do you know there's a loan program available for you that you could actually get an effective interest rate below 2% so that you could go buy the house of your dreams? And believe it or not, you could actually impact your cash flow positively by almost $600 a month. So imagine you could go buy a more expensive home, get it paid off in somewhere between 3 and 7 years, and have an extra $600 a month, even though you have a higher interest rate. If you want to see how that could work for you or anybody in your family or friends that have talked about selling but don't want to give up that 3% loan, please have them call or text me at the number below. What if you shot a video like that, posted it in your social media, sent it to your database? What do you think would happen to your business if you did that? I'd be willing to bet you'd get some calls on it, right? Because our job is to help them understand the benefits of selling. And again, if you listen to last week's podcast, it's a $7,000 difference in their equity. And I only did a 20-year calculation. I didn't even do 30. So we could free up or give them an additional $647,000 in equity and give them a monthly pay raise of $596 to their cash flow. And I didn't even use this loan. I just did, for an example on that, a 30-year fixed at 6.5. Imagine if I actually did it on this loan, what that would look like. Our goal is to be able to teach people how to build wealth using their real estate, right? That's the purpose of the Real Estate Asset Advisor Group, is to be able to teach people how to use their personal residence to build wealth. And if they want to invest in other things and buy second home, hey, we're there for them. But no matter what, from their personal residence, we can turn them into multimillionaires. Now imagine if I actually put this loan in place and use those numbers for what I did last week. Imagine what the difference would be. So again, I don't expect you to be an expert in this or understand all that, but I wanted to give you the talking points. One of the number one questions we get is, why haven't I heard about this loan before? My answer to everything is always follow the money. Why would a lender want to give up several $100,000 in interest? And the answer is they don't. But this lender makes their money that way and they can do it in volume. It's always about following the money. They just made a conscious decision to say, hey, what if I put a great loan program together for people? Have to explain it to them, no question, because they're going to have natural objection to an adjustable rate or a HELOC or just anything that's different, right? Different always scares people. And that's really done by design, folks. Why is it so scary to take out anything other than a 30-year loan? Because Fannie Mae and the government and the media have convinced people that's the way you do it. But you're paying 100% interest on the money. 140%. I'm from the south side of Chicago, guys. I could go get money at 20% back in the day. 140%. So the government doesn't want you to know about this. And the reality is most LOs don't want you to know about it either because they keep doing refis over and over again. Remember, if somebody does that loan, this is the last loan they need to do. So it certainly will impact a mortgage loan originator's income, right? So that's why you haven't heard about it. So if you do have questions on it, go ahead and schedule a call, brainstormwithbob.com. You can schedule it ifyoulistyouLast.com. There's a link there that you could hit. But just think about what we've shared over the last 2 weeks now. The financial difference between selling a home at 3%, moving to a 6.5% rate, and that it would add $647,000 to your net worth while increasing your cash flow by $596 a month. Then just imagine if we did it with these numbers and we showed them how to have this house paid off in 3 to 7 years, assuming they qualify, right? Will your clients start looking at you differently than they did before? Are you still just a real estate agent, or do you have a much deeper understanding of what our industry is and how the money really flows in real estate? And once they realize that you're not the average realtor, folks, you're the one they're going to take and hire and refer, right? Our goal in the Real Estate Asset Advisor is to turn our agents into the agent that people are compelled to hire and refer. And how do we do that? By knowing these things, understanding them. And even if you can't explain them, it's okay. Then just get them on a phone call with me and let me do that. And you're going to look amazing to your clients. So I know that's a lot to comprehend. And if you're listening to the podcast, you're going to probably want to jump over to YouTube and just see those screens and go through it. But folks, this is the absolute best loan on the planet. Not everybody's going to qualify for it, but this is what you should be talking to your people about. Make sense? So with that, thanks for listening today. Thanks for downloading, and we will see you next week for week 11. Can't believe it's already been 10 weeks of doing this podcast. Truly, I appreciate you listening and sharing. We're growing very rapidly. Our numbers are really great for a brand new podcast. So that's all due to you guys. So thanks so much. I hope you learned a lot. I hope some of this stuff is starting to click with you again about how you turn this into more business and how much more compelling you are because of your knowledge for people to hire and refer you. So with that, go out, folks, take some listings, because if you list, you last. Talk to you next week.